Imagine a company that's figured out how to turn tough, scratchy plant fibers like jute into a material as soft as cotton. I mean, it sounds like the future of sustainable fashion, right? A pretty exciting IPO opportunity. But what if the company's own official documents, the very prospectus meant to get you to invest, are practically screaming with red flags? Okay, let's get into it. This is a brutally honest analysis of the Yajur Fibres IPO.
So that's really the big question we have to answer today. Is Yajur Fibres a true innovator tapping into this huge global trend of green textiles? Or is it a high-risk gamble built on a foundation that's, well, a lot shakier than it looks on the surface? We're going to tear down their prospectus to find out for sure.
All right, so first things first, what does this company actually do? Their key piece of tech is something they call cottonization. And what that means is they take these long, strong, kind of coarse plant fibers, like linen or jute, and they have a process to make them soft and short. So they basically act just like cotton. The analogy here is perfect. It's like sanding the edges of a square peg so it fits perfectly into a round hole. This is their whole pitch. They're making these sustainable fibers compatible with all the existing cotton machinery out there in the world.
Now, to be fair, you have to look at both sides. There's a pretty compelling story here. So let's start by looking at the bull case, the argument for why you might get really excited about this IPO. This is the story the company definitely wants you to hear.
And look, on the surface, the pitch is really strong. The promoters, the Conqueria Group, they've been in the jute industry for over 80 years. That's some deep, deep experience. The product itself, it fits perfectly with this huge global shift towards sustainable, eco-friendly everything. The revenue growth is, and I'm not exaggerating, explosive. And here's a big one. This is a fresh issue. All the money raised goes straight into the company to build more capacity. The founders aren't cashing out, which suggests they really believe in the future here.
But now we have to do our job as serious investors. It's time to flip the coin and look at the bear case. And let me tell you, once you start digging into the fine print of that prospectus, the whole story starts to look very, very different.
The first massive problem you run into is something called concentration risk. The entire business model, from who they buy their materials from to who they sell their final product to, is built on a dangerously small number of partners. We're talking about extreme dependencies that could literally cripple the company overnight.
Just look at these numbers. In the last fiscal year, over 76% of their total revenue came from just 10 customers. More than half came from only 5. And you know what's worse? The prospectus flat out says they have no long-term contracts with any of them. Think about that. If 1, maybe 2 of these big clients walk away, their revenue could just collapse. That is a terrifying amount of risk to have on your books.
And if you thought the customer situation was bad, get a load of this. The supplier concentration is somehow even worse. Nearly 97% of all their raw materials come from just 10 suppliers. This gives them basically zero bargaining power. Any price hike, any supply chain issue from this tiny group, and their entire production could grind to a halt. This business is unbelievably fragile.
But here's the thing. As scary as all that is, it's not even the main event. The single biggest, most glaring red flag, the one that should make any serious investor just stop in their tracks, is buried deep in the audit history of the prospectus.
Now, what you're seeing here isn't my analysis. This is a direct quote from the company's own auditors. It's called an auditor qualification, and it's basically your accountant raising a giant red flag and saying, hey, the financial statements you put out in the past, they weren't accurate. They are explicitly saying profits were overstated and liabilities were understated. This is a massive, massive governance problem. It calls into question the integrity of the very numbers their entire investment case is built on.
So, with that huge warning from the auditors hanging over everything, let's try to decode the financials. Are the numbers so good they can overcome these problems, or do they just confirm our worst fears? Okay, you have to give them credit for this. The top-line revenue growth is, well, it's phenomenal. It's more than doubled in just 2 years. This right here is the growth story. This is the entire foundation of the bull case, and it shows there is definitely real demand for their product. You can see why people would get excited.
But, and this is a huge but, growth costs money. A lot of money. The company itself projects that its working capital needs, which is just the cash required to run the day-to-day business, is going to jump by 188% by 2026. This tells us that for all its amazing revenue, this business just burns through cash like crazy. It's a very cash-hungry model, and that adds a whole other layer of financial risk.
All right, we've seen the exciting growth story, and we've seen the very serious problems under the hood. It's time to weigh all the evidence and come to a clear, final verdict. Let's put it all together. So here it is, side by side. The bull case is simple.
Great experience, a hot trend, amazing growth, and fresh funds to expand. But the bear case, it's just so heavy. That massive auditor red flag about the financials, the extreme fragility of the business model, the high cash burn, when you put them on the scale, the negatives just completely overwhelm the positives.
So let's get real and break this down for different investors. If you're a safe or conservative investor, this is an absolute 100% avoid. The governance red flags alone should be enough to scare you away. Moderate risk investors, same advice. You should avoid this. The combination of risks is just too high. And even for the most aggressive, high-risk investors out there, this is only for you if you can look at that auditor's warning and that fragile business model and say, yep, I'm okay with that gamble.
So after weighing all the evidence straight from their own documents, our final verdict is clear, simple, and unambiguous. Avoid.
And why are we so firm on this? It really comes down to 3 simple reasons. 1, the auditor's qualification is a complete deal breaker, period. No growth story in the world can make up for questionable financials. 2, the business model is built like a house of cards. Its dependence on so few partners makes it incredibly risky. And 3, there's no strong defensible moat here. The company even admits there are no real barriers to entry, so what happens when competition shows?
And that leaves us with the final, critical question you have to ask yourself. The company is selling this amazing story of growth and sustainability. But when the very foundation of that story, the numbers, the business structure, is this shaky, is any growth story truly worth the price?